In recent weeks, we've only seen the stock market's volatility continue to be really, really dramatic. In the 2 days following the presidential election, the market lost almost 10% of its value. So individual investors may be wondering, how do you value a stock? For instance, a quick barometer is typically looking at a stock's price to earnings ratio. And that's the stock's price per share divided by its earnings per share. But if you take a step back and think about it, if the stock's price is fluctuating wildly from day to day, what does that measure really tell you about its valuation? Is the company really that much more valuable or less valuable after taking these wild swings? So you may want to expand the pool of metrics that you look at. One of the metrics that may be helpful, particularly in tough economic times, is something called free cash flow. And what that is, it's a measure of the company's cash on hand after it's paid expenses. While you want to look at this number, you don't want to focus strictly on the raw number itself. You want to look at how the company is in fact using that cash. For instance, a share repurchase might be a good investment for the company if its stock valuation is low. You want to look at whether the company perhaps is making acquisitions that may not be particularly prudent right now. But also keep in mind that if that number is negative, that's not necessarily a bad sign. Companies that are reinvesting in themselves may post negative free cash flow.